And a very warm welcome to this special programme from IGTV on the outlook for emerging markets. I'm Victoria Scholar and here are your headlines. Time to buy. Emerging markets strategist Mike Harris says this is the, quote, ideal year to invest in EM.
Go aggressive into emerging markets, play this switch from S&P into emerging, and if you start to see the dollar is just ticking up quite persistently, which I wouldn't totally exclude as a possibility, that's when you have to say, okay, I got to retrench back into the US.
The Bolsonaro bounce. Stocks in Brazil hit a record high this week amid growing optimism towards the newly elected right-wing president. And a ruble rally. Russia's annual GDP tops estimates, reaching the best level in 6 years, while the ruble gains more than 5% this year against the US dollar. I'm pleased to say that joining me on set today is Paul McNamara, Investment Director at GAM Investments, and Gavin Serkin, Managing Director and Founder of Frontier Funds, Media and Intelligence. Thanks so much to both of you for coming in. Let's start with you, Paul. With the Fed on pause, do you think that now is the ideal year to get into emerging markets, like Mike was saying in the headlines there?
I don't think I'd go quite as far. I mean, we would see the same major risk, which is a much stronger dollar, which tends to be quite difficult for emerging markets. I mean, EM does well when we're in a global growth environment, and the problem we had last year was we had a very strong US, the rest of the world lagged, the dollar was strong and EM didn't do very well. And I think the risk is that we see the same again. But at the moment valuations look fine in bonds, in equities, in everything. It's a cheapish asset in an expensive world. I mean, I think it's a good time to buy. I'm not sure I'd be quite banging the table yet though.
So we had a question from our IG community which said that in a major global correction, would EM be hit hardest, and wouldn't it be better to wait for a pullback then before getting into emerging markets?
I mean, I think it depends what's driving the correction. We tend not to be very keen on market timing because there's always something out there which could go wrong. If you look at EM and you think it's fair value, then put some money in. Then put some money in now. If you get a major correction or a major growth slowdown, if you get an event in Italy which drives Europe down or something bad like that, I mean, EM is going to suffer, and it's what you call the higher beta markets, places like Turkey, which I think would be particularly hard hit. There's always a risk, but I think, you know, sort of waiting until there's zero risk, you're going to be waiting until there's zero value as well.
All right, now we're going to dig into Turkey a little bit later in the show, but Gavin, I wanted to get your view on where we're at in terms of frontier markets. I know that's what you mainly focus on. We've had a question from our community saying, should we be focusing on EM or more towards the frontier markets?
So I'm bound to say the frontier markets, I guess. I mean, but you've got to be careful. But if you look at which markets are the outperformers so far this year, you've got places like Argentina, which has been going through the roof. You've got Saudi Arabia. Now, both of those happen to be ones that are about to go into the emerging markets index. But like Paul says, you've got to look where value is, and looking across the board, I wouldn't differentiate, quite honestly, too much between whether it's emerging or whether it's frontier. I think these are false classifications in a way. You're looking for which countries have the macro story that you can buy into and which are undervalued right now.
So if we're looking at EM as a basket, do you echo what Paul was saying about the dollar? Do you think that could derail the EM story this year if we get a continued strengthening of the greenback?
Yeah, but we're in a good place right now. Reading the mood music from the Fed, reading what's going on, the latest signals from the trade talks. There's too much at stake for China and for Trump to just let the trade talks drag on for very much longer without some kind of resolution. When you look at the China slowdown, it's not that big a slowdown. It's in some ways it's quite a positive reading, but from the China official sector, that's being read as time to stimulate the economy. So you've got a lot of dynamics that are going into emerging markets and frontier markets that look quite positive right now.
All right, now our guests are here to help you understand and trade the emerging markets complex. So please send us your questions. It's easy, you can post them on Twitter using the hashtag IGEMchat, or by posting a comment on YouTube or through our Facebook Live. Or you can send your questions through the live show by visiting the IG community page online. You'll find the Emerging Markets blog post on the homepage. Leave a question using the comments section at the bottom and we'll aim to put them to our guests during the show. Now, we're kicking off today with Latin America. Many investors are optimistic that Brazil's new right-wing President Bolsonaro will bolster the country's economy. In a speech at the World Economic Forum in Davos, the so-called Trump of the tropics spoke of a, quote, new Brazil, promising to cut taxes, reform pensions and open up the country to foreign trade. Earlier, my colleague Jeremy Naylor caught up with emerging markets investor Mike Harris about Brazil's investment case.
Yeah, I mean, we've seen emerging obviously bounce nicely so far this year, and people always love bespoke stories. You know, when Modi first comes in, people rush into India. Now we're in a place where a lot of people are paying attention. Brazil's doing extremely well because there is a Thatcher-esque sort of leader, and to the extent that that plays through, it could be quite dramatic because Brazil is in need of reforms. It's not a country that can live with the status quo, and investors do not care about democratic shades of gray. So you'll have some angst associated with a lot of his Bolsonaro some policies from a social perspective. Unless that leads to instability, which there's no reason to expect it would, the markets only focus on economic policy and his ability to get that through, and a strong leader, unless he runs into the gridlock that Trump has run into. But even with Trump, you see on specific issues you can create unity that allows them to move forward. So the market's embrace of Brazil right now seems very logical.
Now head to our YouTube channel, IG UK, to catch the full interview with Mike Harris, founder of Cribstone. Paul, let's start with Brazil then, because many voters back Bolsonaro in light of the poor economic record of the left-wing party. How optimistic are you when it comes to Bolsonaro's potential impact on both the economy and markets?
I think cautiously optimistic. I mean, this is almost unique in the time I've been covering Brazil, in that we have the locals optimistic and foreigners a bit more cautious, because having a president who's actually talking about social security reform, they're very impressed with his financial advisor, Pablo Guedes. That's seen as very positive, and I think that's really why we've seen such a rally so far. I think we'd be a little bit more cautious. If you look at the record of strongmen around the world, whether it's Putin, whether it's Erdogan in Turkey, around the world, generally what you get is lower taxes and a weaker currency. You know, that they like to talk the talk, but when things get difficult, when it's hard to get through Parliament, to get through Congress in Brazil, the social security reform, which is rightly dead centre, I think, you know, looking around where we've seen, you know, what your typical Latin American strongman does, I think we'd be a little bit more cautious on Brazil. We've had a ferocious run over the last couple of months. We're already seeing a bit of pushback from Bolsonaro's team. I mean, his agenda is really, I suppose, extrajudicial killing, is a crackdown on crime, if you want to be polite about it. He isn't in any major sense driven by economic policy. So I think, you know, given the rally we've seen in Brazil, we're sort of pulling in our horns a bit.
Gavin, what do you make of the investment case in Brazil? I know you're bullish towards Argentina, so how do those two compare? Where are the opportunities?
Yeah, I mean, just to speak to Paul's point, you know, when you think of the man himself, I mean, I interviewed Erdogan back in the day when he was a young reformer coming into Turkey, leading that country, and who would have known the direction that went in, you know. So there's got to be an amount of caution about Bolsonaro. I mean, a few months ago, The Economist was running the front page of Death of Democracy in Brazil. So, you know, you've got to read the rhetoric. But that said, economically speaking, this is a technocrat that is running the economy, and it's not Bolsonaro's policies that are running what the economic forces are. In Argentina, you've got an impassioned President Macri who is really aligning the economics with the politics, and you know, I think there's reason for confidence in Argentina's economy that's focused around Macri and the reforms that he's doing, and that's why we're seeing such a bounce back.
So when it comes to the Bovespa in particular, do you think it's overvalued given the fact that it's now at all-time highs or thereabouts?
I think there's further to run in Brazil because we are coming back from you know, last year was an extremely good run for Brazil, so you've got to think of it in those kinds of terms. But don't forget, we're talking about Brazil, we're talking about the biggest of the BRICS, we're talking about, or after China, we're talking, there was a report from Standard Chartered a couple of weeks ago that put Brazil as the #5 economy by 2030 on a GDP purchasing power parity basis. Now, I don't know if I would go along with that to that degree, but if Brazil gets it right, then this is a country in the real ascendancy. The caution that you have is around Bolsonaro and just how far he's going to push the democratic agenda back.
So, Paul, widening out to broader LATAM, within the currency space, where do you think the main opportunities are this year?
I think I'd agree with Gavin that Argentina looks very attractive, incredibly high real interest rates. The economy is adjusting. The sad truth is that a big recession is actually the ideal thing for the balance of payments because imports collapse, and if you're earning sort of 40–50% interest rates, all you need is a modicum of currency stability. I mean, all of South America really trades off commodities prices, so you need to be watching China above all. I mean, Colombia more oil focused, but the rest of the region. Whereas Mexico, just watch the politics, unfortunately. But I think as we're bullish, most of EM, Latin America is part of that. So
with Argentina, though, how investable is it really, given the fact that inflation is near 50%?
Well, I mean, that's kind of what we're paid to do you look for macroeconomic instability. What we saw in Turkey last year, we were getting 10% intraday ranges on the Turkish lira. It's part of the deal. I mean, sort of 40% inflation isn't a problem if you have 50% interest rates. Real interest rates are proven, I think, to bring inflation down. It's emerging markets, it's high risk. Be aware of that, but I think if you stick to the safe emerging markets, you're really not going to make a lot of money. So does that mean you kind of have to play it short term, keep moving in and out of different currencies, commodities, etc.? I think it's more about gritting your teeth, that you're going to get these big drawdowns. If you look at a market like Turkey or Argentina, which is going through a very big adjustment, that there are going to be days when it comes off 2, 3, 4%, and you have to look through that. That you see that the underlying trends on fiscal policy, on balance of payments are headed in the right direction. So I think it's more sort of judging your risk and not taking on more than you can afford. All right, now our guests are here to help you understand and trade the emerging markets complex. So please send us your questions. It's easy. You can post them on Twitter using the hashtag IGEMchat, or by posting the comments on YouTube and through our Facebook Live. Or you can send the questions through the live show by visiting the IG community page online. You'll find the Emerging Markets blog post on the homepage, so leave a question using the comments section at the bottom and we'll aim to put them to our guests during the show. Now, the Russian economy grew by 2.3% in 2018. That's ahead of expectations and the fastest growth since 2012. However, there's growing scepticism towards the accuracy of Russia's official data. My colleague Jeremy Naylor caught up with EM strategist Mike Harris from Cribstone, who explains why he's bullish on the ruble.
It's not how could I say, the proxy for emerging markets, because there are other drivers as opposed to risk appetite. So when people want to turn against emerging markets, they'll go after the rand for two reasons. One, because it's large and liquid, and it is a current account deficit country, unlike Russia. And secondly, because they know the central bank will never respond to rand weakness. So it provides a good playground, effectively, for emerging market investors. The ruble is a little more bespoke because there are trends associated with the current account, policy decisions associated whether they're buying FX or selling, and the interest rate dynamic. The central bank has been relatively hawkish throughout this cycle, despite broader deflationary tendencies. So, if you were to say from a risk-reward perspective, you have confidence in the central bank, you're reasonably comfortable with oil, the pickup in inflation has largely been just because of VAT increases, which is a structural positive. They've increased the pension age. Putin's political cycle seems to be working in his favor right now. I would have thought the risk-reward for the ruble, when you're getting an 8% yield and the Fed is now pausing, is pretty good.
Now, don't forget, you can watch the full interview on our YouTube channel, IG UK. Now, Paul, we've seen the ruble appreciate by about 7% against the US dollar since September. Do you echo what Mike was saying there, that there's real opportunities there, given the carry trade and the fact that the Fed is potentially on pause?
I mean, everything I think that was discussed there makes sense, but I think you have to pay attention to what's the single biggest concern, which is US sanctions. I mean, we saw repeatedly last year when there were concerns about US putting sanctions, especially the sort of sanctions they're putting on Venezuela at the moment, which makes it very difficult for foreigners to hold Russian assets. And I think that's what's holding the market back. Absolutely, interest rate, they've got the best central bank, probably best central banker in emerging markets. With the oil price here, the budget's in good shape, the balance of payments is in good shape. But we have a democratic House of Representatives in the United States, and then suddenly you're asking questions like, well, does the President of Russia have compromising videotapes of the President of the United States with prostitutes? This is not stuff which I think we necessarily have an edge in. You have to be aware that there's this risk out there in terms of Russia, that if the United States, if you get change in the politics in the United States and they decide to go after Russia, then then a major source of finance for the Russians is cut off, and I think the clearing price of Russian assets is quite a lot lower than it is.
Gavin, what about the equity market? Because we've seen Russian equities outperform the broader MSCI Emerging Markets Index in the past few months. Do you think that looks set to continue this year?
Yeah, I do, because for all the risk that Paul rightly points out, you've got the direction of travel is in Russia's favour. You've got, as Paul says, high oil. You've also got, you've got various steps which are bringing Russia back into the centerfold. OPEC opening up to Russia, wanting Russia to be part of deeper conversations about oil. What we saw with Rusal, sanctions coming off Rusal, Deripaska giving way to that. This is all about Russia coming back as an economy. The sanctions are still there, but the importance of it right now is loosening to some extent.
Now, you've obviously both touched upon oil, a key determinant of the direction of the Russian economy, and I wanted to bring up a graphic, if we could, which is a chart of the ruble versus oil, and it's essentially showing the fact that there is this very, very tight correlation. That was at least until last year, when this correlation appears to have broken down. So does that mean that oil is less significant for the direction of the Russian economy, Gavin?
Yeah, because Russia is if we look at the past few years, Russia's all about, can it survive on its own in an isolationist sense? Are we looking at Venezuela? In Russia, and right now we're not. That's the answer. And so oil becomes less relevant to Russia's picture. It's not the be-all and end-all. When we were covering emerging markets, before the Ukraine crisis, oil and the MICEX would go in tandem. It's not got quite that connectivity anymore.
Now, Paul, I wanted to ask you about these growth figures. The best growth since 2012, very, very strong growth. But even Putin, at the end of last year, admitted that the data might not be fully accurate. Yep. Should we be sceptical towards the numbers?
I mean, possibly. I mean, even by its own numbers, Russian growth is pretty unimpressive, sort of compared with, even Brazil on a good year, let alone India or the rest of Asia. I mean, the key to understanding the Russian economy is that it's designed for looting. It's meant to make the people who control the governing heights of the economy rich, rather than to improve the lot of the average Russian, which is why we've had no changes on corruption, on privatization, on structural change. So from the point of view of the people who are running Russian economic policy, this is a feature, it's not a bug. I mean, Russian growth is not going to accelerate. I mean, you've got some of the best human capital, you've got the best programmers in the world, but, they're all occupied sort of stealing your credit card numbers rather than creating the next Facebook or whatever. Russia is not an economy that's designed for classical productivity-driven GDP growth. It's designed to deliver rents to people who control the right bits of the economy.
But that would suggest that we should steer clear of investing in Russia, and if we'd followed that advice some months ago, we would have missed out on a lot of these gains.
I think you don't make it a core holding. If you're going to hold, the case behind emerging markets is that you're going to have these countries which go from low income to suddenly, on a par, which has been Asia, it's been Central Europe. There's a decent case that it can be some of the others. Otherwise, I think Russia looks much more like the South American countries. When you have a good run of commodity prices, they do very well. Commodity prices, in the case of Russia, oil, eases off they do as well. So I think Russia makes much more sense as a cyclical play rather than as a core productivity-driven growth play, the sort of thing that you'd hold for years.
All right, now let's switch to Turkey a second, because of course we had that major currency crisis in August of last year. It's restored about 22% of its value since the lows in September. I mean, is there a risk, Gavin, that these problems could resurface?
Yeah, I mean, Turkey, like Russia to an extent, is in a much better place than it was this time a year ago. It's played its geopolitical hand extremely well, you know, whether it's Syria, whether it's the Saudi situation. You know, these are instances that that Erdogan has really taken control of, and that has, you know, geopolitically, Turkey is in a good place right now, and it looks stronger on a macro level, and that does feed into the economy. You know, people feeling good about their place in the world, I think, you know, does have an economic ramification.
All right, now our guests are here to help you understand and trade the emerging markets complex, so please send us your questions. It's easy, you can post them on Twitter using the hashtag IGEMchat, or by posting a comment on YouTube and through our Facebook Live. Or you can send questions through the live show by visiting the IG community page online. You'll find the emerging markets blog post on the homepage. Now, let's move on to China now, because it's Chinese New Year this week. Celebrations may have been tempered by its slowing economy, trade tensions, rising debt levels, and softening growth are weighing on the world's second largest economy. But despite this, the yuan has been strengthening since November. Earlier, we spoke to Nick Parsons from Thomson Lloyd, who gave his view on the outlook for dollar CNH.
So as long as we don't print 7, and I don't think we will, then I think the outlook for equity markets is good. There's a little bit of there's a feedback loop here, if I could call it that. The Chinese authorities are moving the fixing of the exchange rate to be more market driven. But of course, they in turn are the biggest market participants through the state-owned banks. So they themselves give signals to which the fixing is then allowed to respond. So it's far from being a true market-determined exchange rate. But it was noticeable when we had that collapse in EM equities in the fourth quarter of last year, and when that Chinese equity sell-off accelerated and deepened. That was at a phase when the exchange rate was being allowed to move up towards 7. Now, once they backed off from that, and then we saw some stability and then a rally in equities, I think that tells us the clues that we have to look for.
Now, Paul, I wanted to get your view on emerging markets, in particular China, and in particular the trade wars, because we've had a question that's just come through from one of our viewers who says, if the trade wars drag on, does it mean that investors should be holding off from EM?
I don't think so. I mean, if you look at the degree with which countries trade with the US, especially manufactured goods, which is the jobs, which is where the jobs are, which is what it's targeted on, it's really Mexico stands out beyond comparison with any other country. I mean, even if you look at places like China, it's, you know, 20% of the economy is manufacturing exports, 20% of that goes to the US. It's not that big a deal, 4% of the economy. So you could wear quite a big drawdown. I mean, China is an investment-driven economy. What happens to Chinese growth is going to be driven by investment, which means it's going to be driven by credit, by stimulus. The trade wars are good for a lot of noise. They're probably more important to equity prices, even US equity prices, than they are to EM investors. We kind of cut through that what matters in China is investment, not trade. So watch the credit numbers.
All right, so Gavin, do you agree with that the trade tensions are more likely to have an impact on the equity market? Because we've seen the Shanghai Composite have a pretty good start to the year. It's up around 6% or so. Do you see those gains continuing? And when it comes to the trade wars, of course, we've got the 1st of March deadline that's looming large. Do you see this theme continuing throughout the rest of the year, or are things going to shift as we move into spring?
Yeah, I mean, there's two ways of looking at it. First, from a valuation perspective, China had a huge crash last year, and we're still recovering from that. Yes, we've had a bounce back, but valuations are still very low compared to where they have been, and also low by comparison to international benchmarks. So China looks cheap still. From the trade war perspective, you know, it goes back to what I said earlier. I think there has to be a breakthrough. I don't think that this is sustainable, and there is reason to think that China will also start more on the road of fiscal easing and trying to do what it can to push the economy. So China spends a lot on things like the Belt and Road Initiative. Some of that money is being pulled back. You know, they're not spending as much. You know, the Belt and Road Initiative money has been capped at the 60 billion. So and a lot of these big projects that China was involved in have been rowed back to some extent. So we see that China is now focusing much more on its domestic economy and getting that moving.
So, Paul, you said that we should be focusing more on the credit market. So that brings me to the debt picture.
Yep.
I mean, I've heard that, according to the IIF at least, debt to GDP could be as high as 300%,
yep,
sharply higher than its official figures, around 47%. And to put that into context, that compares with the US, which is around 105%. We know those deleveraging efforts are on pause for now as it looks to continue to grow economically. How concerned are you about the debt picture?
Yeah, I mean, that 300% is all debt, both public and private sector, so it's not exactly comparable.
Okay.
I mean, given that China has a closed capital account, it runs a capital account, current account surplus, it's much harder to see the sort of trigger that we saw in the global financial crisis in places like Ireland or Spain or Greece or the other Asian markets in 1997, which are countries, you know, running a current account deficit, which are dependent on foreign finance. I mean, China is much more self-contained. So from that point of view, it's much more likely to look like Japan or even Italy, where you don't have that external constraint, so you have a long period of very slow growth. So we're not worried about a crash in China, a sort of debt-driven crash. I mean, I think at some point there's going to be a shakeout. The financial system will need recapitalisation. People are going to have to take losses. But we're a long way from the sort of Thailand or an Ireland-style crash. I think, you know, in the short term, we're going to see that credit number rise. We're going to see another attempt at stimulus. And there's going to be a horrible problem at some stage, but it's going to be a problem of slow growth.
And what about the yuan? Where do you think we go next?
It's going to follow the dollar. You know, when the dollar is strong, the yuan will be weak, and vice versa. China trades a lot more with emerging markets, so when the dollar is strong in its own right, it's very strong to hold the yuan. So dollar strength is going to be met with yuan weakness. I wouldn't agree with the fetishization of 7. I don't think the psychological levels matter. I think you just watch the dollar and expect the yuan to do the opposite.
All right, now let's switch on to India for a second, because it's now become the fastest growing economy in the world. Does that mean that there are more opportunities now there than China, do you think?
You've got to be very careful about the approaching elections. You know, that's going to be very significant if you're making a case for investing in India right now. You know, Modi has achieved quite a lot. You know, I'm probably more positive on Modi's legacy than a lot of people out there. I think that what he's achieved with the demonetization and, you know, getting India more technologically driven has been very impactful. Been about deepening economic growth. You know, so it's not just about the headline number. It's about how that growth is actually being spread out through the Indian economy into the villages. So I think there's reason for optimism that train continues, but you know, come May, June, you will need to be really reading the tea leaves. So
for investors looking to trade India in the run-up to the election, do you think that Modi's most likely to win, and will that bolster the Sensex?
I think Modi is likely to win, you know, but just based on what we can see now, and that will be somewhat a relief because it's continuation of what we've seen until now, which has like I say, a mixed legacy. But as you said before, you know, the growth numbers have been climbing with India, and you know, more of the same is probably from an investor perspective better than the uncertainty of what we'd face otherwise.
And Paul, for you, investment opportunities in the rupee, do you think?
I think there's some opportunities. I mean, the balance of payments isn't all that strong, and I think the oil price is incredibly important to India. That where you see, say, Russia and Colombia do very well on a stronger oil price, India's always been probably the most vulnerable. But you know, subject to the oil price, I agree. I think there's an election cycle to trade around. The rupee is moderately cheap here.
All right, now we're running out of time, so I wanted to take it back to the broader EM complex and field you a couple more questions from our IG community. We had one saying, do non-conventional assets like Bitcoin have an effect on emerging markets? What are your thoughts, Gavin?
I mean, I don't think from a trading perspective, not from, whether you're going to buy a currency or, versus Bitcoin, but in terms of the real economy, Bitcoin is extremely popular in places like Zimbabwe because, if you're facing the Zimbabwe dollar with the collapse that we've seen or the Argentine peso, rolling it back a year or so, then the Bitcoin risk looks pretty good. More significantly is blockchain. Blockchain is technology that will unlock a huge amount in emerging markets. So if you're looking at companies that have a smart way of interpreting how to use blockchain in how they reach out to consumers, whether it's in property rights, whether it's institutions of trust, understanding each individual's personality and characteristics, that's the place to really focus.
And very finally, what's your top investment idea in emerging markets right now?
I say Vietnam, because Vietnam is, it's kind of, people look at the trade wars as being a zero-sum game. Vietnam is kind of a place where, Chinese factories will base to skirt sanctions.
And through the currency markets or?
Through the equity markets primarily, because you've also got the potential upgrade from the MSCI into emerging markets.
And Paul, same question to you.
I think the best places to invest are places which blew up last year and where things are getting fixed. So that makes it Argentina and Turkey.
All right, thank you so much both for your time. That's all we have time for today. Thank you to my guests, Paul McNamara, Investment Director at GAM Investments, and Gavin Serkin, Managing Editor and Founder of Frontier Funds Media and Intelligence. It sounds like there's some kind of alarm going on in the background, but we'll power on anyway. So to continue I can't hear. Thank you so much for joining us, and we'll see you soon.
There has been an incident reported.